Hey everybody, welcome back to Chipstock Investor. Today we're going to be talking about one of the best company names, AppLovin.
One of my favorite comments in the last year, I think it was back in May when we did a video on this same topic. Someone called AppLovin the Motown hit of Silicon Valley. Love it. What are we actually talking about today, Kasey?
We're actually talking about a few different points. The first is, what is the best use of AI so far?
Hint, not us here at Chipstock Investor. I know NVIDIA has done great work making these beautiful avatars, but we have a much better use for AI than that.
NVIDIA Broadcast needs a little work on the blur function. You can probably tell. Point number 2, who is the biggest AI beneficiary and how? Third point, the power of the Google platform. And the fourth, and maybe the most important is there still time to buy AppLovin?
On that fourth point, we hope you get a whole lot more enjoyment out of learning about these businesses, and you're not just skipping ahead to see what we have to say about AppLovin stock. You are at a disadvantage if you're just doing that. Please take the time to learn about these companies. There's some really interesting stuff happening.
We have a couple of charts from the two biggest communications companies, no longer IT companies, but really communications companies, Google and Meta. Google and Meta's revenue continues to go up, and primarily that's due to ad revenue.
So the best use of AI so far, hate to break it to you, but the same thing the internet has been doing for the last 25, 30 years, making a lot of money off of online advertising. AI is immediately being put to use to do exactly the same thing it's been doing for the last 25 years, deliver targeted ads to you that help companies operating on the internet land a sale.
We've been focusing a lot on data centers, the GPU data centers that NVIDIA is creating, and that's where all of that revenue is going from big hyperscalers like Google and Meta. But what is AppLovin providing to companies like Google and Meta?
Yes, so as companies like Google and Meta purchase and install these big clusters of NVIDIA GPU-powered servers in the data center, what exactly are they getting used for? These data centers, powered by GPUs, are providing the infrastructure for the top of the funnel of the economic hierarchy, products and services. Product and service sales are worth trillions of dollars per year, and in order to make those trillions of dollars per year in sales, companies want to market what they're selling. They want to make ads, and they want to get better and better at delivering those ads to a qualified customer, someone that is actually going to make a sale. That's how you get return on investment from an ad. And so Google and Meta are building that infrastructure to do just that. And they're using NVIDIA AI, accelerated computing systems, to make the delivery of those ads more valuable, more targeted, delivered to more relevant customers.
And what does all this mean for AppLovin? Awesome returns over the last few years. You can see since the start of 2023, AppLovin stock is up over 1,200%. Not bad.
Yeah, 1,200%. This is perhaps the biggest beneficiary of this whole AI thing since the start of 2023. Around the same time, NVIDIA did its crazy parabolic revenue and stock price move. AppLovin has sort of one-upped NVIDIA somehow, thanks to AI, and specifically AI delivering relevant ads. Take a look at the basic services that AppLovin provides its customers. These 4 services are housed within its software segment. App Discovery helps app developers market what they've created to potential users. So pretty basic. But again, with the power of AI, the developers themselves can go out and find a potential user that is going to bring some value to what it is they spent all their time developing in the first place. That second one, Max, that's the monetization tool. So that's once a developer has the app out there with users, they can now place ads within that app, and marketers can buy that ad time. All of this is on AppLovin's proprietary platform. So there's no separate platform where they use like a sell side platform and a buy side platform like a Trade Desk or a Magnite or some of the others out there. This is AppLovin's own thing. So they get a lot of value out of this, helping developers match their ad time up with a marketer that, wants to get qualified customers themselves. And again, because of this AI algorithm that AppLovin has developed, apparently these marketers are getting a lot of value. The developers are getting a lot of value for selling ads. And thus, as we'll show you here momentarily, a pretty big jump in revenue for AppLovin as a result.
Those last two services that AppLovin provides adjust what are all those ads without analytics software. That's what that is. Analytics software that analyzes exactly how well ads are doing on these platforms. And then the last one, Whirl, is a newer acquisition for AppLovin just a couple years ago, and it is for connected TV. Connected TV is any type of internet-based TV service like YouTube TV, perhaps. You can see how well the services are going for AppLovin. This is just the software revenue portion of the business over the last trailing 12 months. The last 12 months tops out at just over $2.4 billion in software revenue.
And of course, it's not revenue that pays the bills and makes stock prices go crazy, like has happened with AppLovin the last year and a half, 2 years. It's profitability. And the market really, really likes what it's seeing from AppLovin's very profitable software revenue. Adjusted EBITDA, earnings before interest, tax, depreciation, and amortization, a common metric for fast-growing software companies, well over 70% EBITDA profit margins in the last year. Pair that with the very rapid growth of the software segment. Yeah, Wall Street is very pleased with what it has to see. And the expectation has been set by CEO and co-founder of AppLovin, Adam Foroughi, that 20 to 30% revenue growth is kind of AppLovin's expectation for years to come. So it's all going to ride on how good these AI algorithms are and their ability to continue to improve upon them. But so far, so good. Before we move on and talk about AppLovin's own app development segment, the part that actually makes video games that make use of this software, a word from the sponsor of today's video, Public.com.
With the Fed decreasing interest rates, it may be time to take a look at the bond account at Public.com. You can still lock in a 6% or higher yield with the bond account at Public.com/CSI. That's a pretty big deal.
The reason that's a big deal? Well, when interest rates drop, the interest that you can earn on, let's say, a savings account at the bank tends to fall as well. But with a bond account, which is a fund that invests in corporate bonds, you get to lock in a higher interest rate for a longer period of time. That's exactly what Public.com has done with its bond account.
So while other people are watching their returns shrink, you can sit back and get regular interest payments. But you may want to act fast because your yield is not locked in until you invest. The good news is it only takes just a few minutes to sign up at Public.com. Lock in a 6% or higher yield with that new bond account. Public.com/CSI.
All right, let's talk about some of those app development companies that AppLovin actually owns. Here's some of the games that AppLovin app development segment is responsible for. Maybe you've played some of these. I'm partial to Wordscapes there on the left. Kind of a good time waster when sitting on a plane. Sorry, Candy Crush isn't on this list, Kasey.
Nope, that's what I like to play on the plane. Oh well.
So at this point, this is a much smaller segment for AppLovin than that software that has all the AI-powered ad delivery and ad targeting services for developers and for marketers. This segment had its best days during the pandemic when everybody was stuck at home, playing games on their phone. Things have kind of declined since then. Part of this revenue is in-app purchases. So that's when someone buys maybe like a power-up or something inside of one of those mobile games. And then in-app advertising is the ad revenue that app developer earns when an ad is delivered to the user inside the app. So maybe you beat a level and then you have to sit through a 15-second ad or something. AppLovin earns a little bit of revenue every time that happens. The revenue does seem to have stabilized, but that's okay. Revenue growth isn't really the primary purpose of this segment anymore. AppLovin's just trying to squeeze every penny they can out of this. And so the real thing to focus on here is, again, the adjusted EBITDA margin. You can see it jumping back above 20% again. So that's good. Not the primary focus these days, but at least they're making a little bit of money off of their video game segment.
Now, as you may expect, AppLovin has some pretty big competitors. In regards to the advertising portion of the business, Facebook, Google, Amazon, and Unity Software, all of those companies have a very large portion of the business dedicated to advertisements. And then in the app portion of the business, they have a few competitors like Activision Blizzard, which has been acquired by Microsoft, Tencent, and Zynga or Take-Two Interactive. All of those app developers also have their own integrated advertising system.
And this puts a company like AppLovin in a tricky spot because some of their competitors are also users of the software. So very strange, but this is a part of the digital advertising market that we've highlighted over on our Discord channel, part of the Semi-Insider membership. Companies will spend their advertising dollars wherever they're getting the best bang for their buck. And so even if that's with one of your competitors, if the return on the ad campaign is good enough, you might still be willing to funnel money their direction if it's getting you good paying users in return. And this is the risk for a company like AppLovin because many of these competitors obviously can go on to develop their own competing algorithm, their own competing service, and then pull that revenue back out of AppLovin and use it themselves on their own proprietary system. It's a tough game. And one of those users / competitors, let's call them a frenemy, is none other than Google.
Back in 2020, AppLovin started working with Google and they trained their AI algorithm in the Google Cloud. And it appears that they have been using it ever since.
Yet the relationship seems to have gotten even deeper in 2022 because then at the beginning of 2023, there was another joint PR release where Google said that AppLovin was going to be one of the first users of the G2 virtual machines. So these are servers that run in Google Cloud. A company like AppLovin can use these virtual machines to do things like train an AI algorithm, or once the algorithm has been trained and it's ready to get put into use, they can also use them to run inference. So that's when the AI takes in new data and makes a decision. So in this case, it would be deciding where to deliver an ad, which user is the most qualified potential purchaser of a product or service that's being marketed to them. And these Google virtual machines were one of the first to use NVIDIA L4 GPUs.
This is NVIDIA's L4 GPU unit. Doesn't get a lot of love these days. Everyone's talking about the H100, H200, and now the Blackwell system. But the L4 is still a very major player in AI inference. Some of the other users besides AppLovin that have used the NVIDIA L4 are Descript, which is one of the products that we use here at Chipstock Investor, X, Snapchat, Google Cloud, all kinds of companies. This is the power of Google Cloud. This slide outlines the commitments that AppLovin has with Google Cloud, primarily through 2025, but all the way until 2027. The total purchase commitments from AppLovin to Google will total $555 million. They have about $252 million remaining on those commitments.
So as Kasey said, this is the power of Google. It's training these AI algorithms itself for use with Google search ads. It's still today, it's bread and butter. And it can use these same services to go out to a company like AppLovin and say, hey, look at what we've been able to accomplish. You can use these same virtual machines powered by NVIDIA to train your own AI algorithms for ad targeting as well. And AppLovin has done an exceptionally good job of doing that. But again, Google, super powerful. It makes money off of the ads itself, and then it can turn around and take that hardware and rent it out as cloud infrastructure.
Let's now focus on the balance sheet for AppLovin for just a moment. The light blue bar, total cash and short-term investments, dark blue bar, long-term investments, and that orange bar is their debt. You may wonder why they have so much debt, but every time AppLovin gets some cash on balance sheet, it actually repurchases their own stock.
Yeah, and more than just the cash on balance. They've taken out debt the last couple of years to gobble up as much stock as they possibly can. The management team clearly thinks that there is a tremendous amount of value in the stock. And even in the second quarter of this year, they were still repurchasing stock. Let's see if that trend continues through the second half of 2024 and beyond. But obviously, given what the stock price has done in the last 2 years, obviously that's been a tremendous use of cash for AppLovin thus far. All right, hopefully you haven't skipped ahead to this point, but we'll answer this question briefly. Is it too late to buy AppLovin stock? Kasey, what's the valuation on a price to earnings and price to free cash flow basis.
On the last 12 months, price to earnings right around 61x, but based on Wall Street expectations on a forward-looking basis, price to earnings around 36 to 37x. Not as cheap as it was.
No, it's not.
Let's take a look at price to free cash flow valuation. On a price to free cash flow basis, blue line 34 to 35x, and then on a forward-looking basis, based on those Wall Street expectations, around 24. So a little bit more attractively valued.
The discrepancy between the two, of course, as is almost always the case with a software company, between GAAP, earnings per share, and free cash flow is stock-based compensation. That's one of the reasons they've been repurchasing so much stock, to offset that stock-based compensation and then some. So again, as this company matures, those two metrics will gradually converge over time. But on a forward-looking basis, I think we're of the opinion here that the stock is hot. It's gone up obviously a lot, brought the valuation far above what was looking like a very cheap stock last year and early, especially early in 2024, as AppLovin flipped to profitability on both a GAAP and adjusted basis, free cash flow basis. But I think we're of the opinion at this point, we're going to continue holding the position that we have. This doesn't look like an egregiously overvalued business. If AppLovin can continue delivering 20% or more revenue growth, like management thinks it can, and can keep those profit margins elevated, especially for that AI-powered software segment.
We've been having lots of discussion about AppLovin and many more stocks over on our Discord channel. You can get access to that via a Semiconductor Insider membership. Link in the description below to the Ko-fi page where you can get that membership access. You get all kinds of good stuff, live Q&As, lots of discussion, and all of our video notes. Check it out. We'll see you again very soon at Chipstock Investor.